Yo, what's going on, everybody? Welcome to the channel. Today, I'm going to be talking about the stock market. It's going to be a pretty baseline introductory video talking about what is a stock, how do I buy them, how does it work, how do I evaluate them, all that kind of stuff. So thanks for all tuning in. This will be financial education episode number 3. So starting off simple, what is a stock? A stock is a share of ownership in a company. So when you buy a stock, you become a partial owner. I like to think about a giant pizza where every single slice is a share or a stock, and the more people demand these shares, the price is going to go up, and vice versa. When people are bearish, they don't want to buy stuff, then the price goes down. So on the right here, obviously I just spoiled one. So when you're bearish, you're not very optimistic about what's going to happen in the future, and you are not going to really be a long-term investor or a short-term investor. Bullish is when the opposite, when people are very optimistic and they think that the value is going to shoot up, so they're pouring money into the stock market. That's going to be a bullish market. A long term would be exactly as it sounds. You're buying something now in hopes to go sell it in a year or two or plus. You're going to be a long term investor. And then shorting is actually a pretty unique term. It's basically betting against the market. So saying that I'm going to sell everything now in hopes of a favorable price in the future. So you're basically betting against whatever stock you're shorting. So how do you purchase these stocks? Through a licensed broker. So back in the days, you'd have to call somebody on Wall Street and they'd put an order in for you. You'd have to pay them commission, all that kind of stuff. But nowadays, it's super easy where there's a ton of platforms out there that allow you to buy and sell stocks from the comfort of your own home. So why would companies even issue stocks in the first place? In simple terms, just to raise money. I like to think of it as like a bond or like a bank giving out a bond. They want to go play with their money right now, so they're incentivizing you to buy this asset like a bond would be or like a stock is, in hopes that you kind of pour money to them so they can go ahead and invest. And they make the hard decisions, and you just have an asset that should gain money over time. So typically when we scale a lot of companies, we talk about the market cap. It can kind of sound confusing, but it's just shares outstanding times share price. So all it is like Apple. It was at $149 for a little while. There was 16.326 billion shares out there. So the market cap was $2.37 trillion. It's just basically how much money is produced with these stocks, how much money is like floating out there in these stocks. So obviously as the price goes down, the market cap goes down. And yeah, so companies are oftentimes measured by their market cap. So we have large, medium, and small. Large caps are going to be your bigger $10 billion plus companies, already established. I mean, these are probably going to be the companies that you invest in if you want to see minimal growth and you just kind of want to, just have a safe security, a safe place to put your money. Median cap would be, the potential to become great. A company that hasn't really flourished yet, but is, definitely has some higher potential. And then small caps are going to be like I'm not gonna say like penny stocks, but your lesser known stocks where you're definitely putting some risk into buying these, but they're seeking aggressive growth, so it could definitely pay off. Classifications, these kind of fit in as well. Income stocks would, yeah, be your powerhouses, your juggernauts of the economy, Tesla, Apple, Microsoft, that kind of stuff. Growth stocks are that like what I say like the medium cap. So good potential to outpace the market. Amazon Twitter actually would probably be more of an income stock, but maybe something that's kind of dropped like a Meta. A Meta dropped a lot recently, but they could definitely be a growth stock because I think that they have a good future ahead of them. And then value stocks, they're going to be the undervalued, unfavorable in the marketplace, but you're going to assume that they have potential to outpace a lot of what's going on. So stock sectors, we compile these into like 11 kind of sectors. And if you're watching my video yesterday on inflation, I kind of went over this a little bit and just how the market kind of reacted. So yeah, I mean, you can kind of pick a niche if you care to and invest in that kind of. I would definitely recommend staying away from number 7 financials, like just at this current time. I think that in a year or a few months, it could be a really profitable opportunity. But for now, I would definitely stay away from financials, maybe healthcare, and then definitely real estate. I think that those are something to definitely avoid. Energy tends to be pretty stable, but like I said, we're in a very unique economy right now. It's hard to kind of guess what's going to happen, but my two guesses are that financials are going to crash a little bit and real estate's going to crash a little bit just because of the interest rates and stuff that we're seeing right now. So let's talk about index funds. If you're new to the market and you want a great place to invest, this is an amazing place to start. An index fund is basically just a compilation of stocks that get all thrown into a basket. So you see the losses and the gains from all of them combined. So it can be a good way to kind of diversify and avoid putting all of your eggs into one basket. So the most popular is the Nasdaq. I'm pretty sure it's just about every single stock that's on the market all compiled together. So when you kind of want to see how the market's doing for the day, you just check the Nasdaq and it'll be up 1% or down 1% would be like that's a pretty aggressive growth would be like a couple percent would be like wow, what's happening, you know? And then yeah, here are just a couple other ones. You can kind of look into them all yourself. But yeah, like the S&P 500 is basically just America's biggest 500 companies altogether. So this is a pretty darn safe way to put to invest your money if you're looking for minimal growth, but to outpace the 0.005% you're getting at your bank or whatever the deal might be. So evaluating risk. Yeah, this is kind of a thing that I'm not a financial advisor. I'm just a dude, right? I'm just a dude on YouTube that kind of likes this stuff a little bit. So don't take what I'm saying and go invest aggressively. Only invest what you're willing to lose. I mean, in all actuality, man, we might see the stock market tank multiple times again. Who knows? I don't know. So yeah, only invest what you're willing to lose, especially in smaller caps. If you invest in huge companies, you're probably going to be pretty safe. You're not going to be prone to these terrible drastic losses that a lot of these companies have taken. But if you're a risk taker and you like these smaller caps, like sometimes I do, then yeah, you have to know that you might never see this money again. Or it might decrease to a drastic proportion where it's like wow. So yeah, understanding your limits to investing. How soon do you want to see this money again? I think that's an extremely important question that not a lot of investors really ask. They just say that, hey, I have this money right now that I'm willing to spend. But I think it's important that you have to liquidize that at some point. You have to get money back. You have to get your cash back. Um, so yeah, just as important as finding a time to buy, you have to find a time to sell. If you never sell your stock, then what good is it? It's just floating around somewhere. You might as well go put some money on Ben Simmons to drop 30 points tonight. Like you have to liquidize your money again, right? So understanding, and it doesn't have to be a set in stone thing, but understanding I want to invest today, I want to see it in a month, I want to see it in 6 months, a year. I think that's a super important thing to kind of think about before you throw money to the stock market. So when you do kind of narrow down how where you want to put your money, evaluating a company is super important. So three very very important kind of sheets in tools. I guess I would call them tools more than anything to kind of understand what's happening in your company would be the balance sheet, which is kind of how they balance assets and liabilities out. The income statement, which is basically just showing where their money's going, total revenue gains minus total expense and losses. And then cash flow statement is divided into three sectors or three categories. But it's basically just saying, yeah, where is their money flowing to? How much money are they spending on operations, investing, and financing? So these are all things that you can look at, and I could probably make a video on just these three myself, or on just these three themselves. But yeah, I'm not going to go too far into them. But just know that these are three very important financial statements that you can look at. And then yeah, I guess five kind of words to consider: valuation, profitability, liquidity, debt, and inefficiency. So understanding how your company runs or understanding how the company that you want to invest in runs is super important because I mean, like I said, you are going to be a partial owner in this company. You should fully understand their business model, where they're putting their money at, their profitability, all that kind of stuff because you're truly backing this company. You are putting your hard-earned dollars into them and saying, hey, I trust you with this. I trust you to go make smart decisions with my money. So it's important to kind of understand these five terms. And then finally, my advice for ambitious traders today. I would say be patient. The market is in a volatile spot right now. We're going to see these kind of fake rallies where kind of people are getting optimistic again, but just know that with interest rates this high, we're not going to see a crazy bullish run. I mean that's opinionated, of course. That's just my opinion, but I think it's embedded in a lot of truth because with interest rates this high, we don't have money to I don't know. It's a tough spot right now. So just be patient. Make a watch list. Go on. I know Yahoo Finance is a really good resource. Make a watch list and kind of watch these stocks throughout a couple of days. It does no harm. It's just a notification, just a buzz in your phone once a day that says these are your top gainers. These are your top losers. So understanding, and then my favorite, which I'll show you in a second, I'll kind of go through like a quick valuation in a move that I made in the market recently. Um, but yeah, I guess finally the worst is yet to come, in my opinion. I think that real estate is going to kind of tank, and then that's when we're going to kind of see a reset in our economy. So just know that stuff can, just because we've seen a 40, 50, 60% loss in a lot of stocks, it can go further. Don't underestimate what's happening right now in the market. We're in a scary place right now. So let's go ahead and let's take it to Google. And so you can always search up the ticker of your company and it'll give you it'll give you kind of this screen right here, which you can see the relative growth over, 5 days, a month, a year, all that kind of stuff. So a move that I made in the market that I'm pretty proud of recently happens to be with CYH, Community Health Systems. So it's Fortune 500 company, so it's no small company, but it's kind of one of those medium growth, where it has a lot of potential for growth, but also it's volatile. It could get hit, and it did. So I bought in right here. So I have a watch list that shows me the biggest losers in a day. And I happen to see that CYH, I think I'm pretty sure it was more than 40%, but it was pretty sure it was up, like upwards around 50%. So I saw that it had lost that much, and I was like, look, I want to get a piece in this, And it happened that it wasn't even the best place to buy. It actually got, down to $2.22. It actually got a lot lower. So even from the favorable time that I bought, um, it was still down about 20% to where I could have bought. So I didn't get the absolute best time to buy, but it was still a fair time to buy because I saw this drastic loss, and I was like, look, they've got to bounce back to some extent, right? And they did in the short term, and then they kind of fell again. So I kept on holding this. I held it for a while, and just recently I saw this, so it was up 70%. So I could have taken out and been okay, and been great. I could have been in a steady position, but there was this crazy gain over one night. It gained what, 50%. It gained 50% a day, and a lot of people would be kind of like, "Whoa, I should keep holding," But for me, I saw all I needed to see. You know what I mean? When I saw a jump like that, and that was all that needed to be said. And then I think I ended up missing it kind of by a day, so I was down more in this like 130% gain range. But still, like, what can I say, man? This was a great move for me. I feel like because I saw this downtick, I bought in, and then I saw this uptick and I sold. I mean, it can be as simple as that, and not every stock is going to have these more like drastic moves. Like this is, cutting your stock in half is crazy. We're not going to see that out of, and this is in a day. This is overnight or over a weekend maybe. So we're not going to see that in big like Apple or big companies, but you kind of get these like middle ground companies that have potential for growth, but also are getting hit every once in a while. You can kind of see that you can make moves like this that seem so simple in hindsight, but at the time they can be kind of like they're risks. It's always going to be a risk. You know what I mean? So that's really all I have for you guys. I really appreciate you all tuning in. I hope I taught you something. Hope I didn't drag on too long. But yeah, if you have any questions, leave them below. I want to really run with this kind of stock and with this like stock niche and kind of show you what I have investments in, why I do, and kind of evaluate companies with you guys. Because yeah, I have a watch list that I'm pretty optimistic about. I think that in the next 2 to 5 years, it's gonna be proven a great investment. So yeah, I appreciate you all tuning in. Leave a like, don't forget to subscribe, and I'll see you all next time. Have a great day.